Today, we're looking at 7171 Lucky Drive West, Jacksonville, Florida, 32208. Price under $130K. Already rented with a resident in place through 2023 and has significant rent upside. I think we do need to start the NYAI Awards, man.
Ooh, I think that's got a nice ring to it. It's like the Emmys, the Grammys, and the NYAI Awards. There you go.
NYAI Awards. Rolls off the tongue. You know what else rolls off the tongue, Greg? Thursday edition of the Not Your Average Investor Show. I am your host, Pablo Gonzalez. With me, as always, the guy they call GC because he generates cash flow because of his genius concepts, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
You are off the rails today, brother, and I'm super excited for this show, and I think everybody is too. When you start that way, it can only be pretty much it's going to be a Hall of Fame show. I know it. So
I was like, what's roll off the tongue? I'm like, oh, maybe I can do that. You know. I try to come provocative with new things to keep it engaging. And today is a provocative day because today is the JWB Rental Income Property of the Week.
Week.
Oh man, I feel like I just went full stupid there. So welcome everybody. It's good. Sheila Bishop, good to see you back for the third time. This is fantastic. It's good to see you. Stevie B in the house. Love to see you, Stevie B. Leo, love to see you back. Chris Bernard, like we said, love having newbies on the show. I hope that you are not turned off by my idiocy right now and that you realize that Greg is a serious fellow and he's going to give you great advice while I'm goofing around out here. Couple of things that is the trick. The trick to the show is that this is interactive, right? Like we really, what we did is provide a platform to be able to put your knowledge on the stage, and that knowledge comes with questions, right? And the best way to interact with us is what you're doing right now in the chat. Little trick to the chat is the fact that when you first start chatting with us, for example, Sheila, for example, Chris, the text box is defaulted to only speaking to us, the panelists. So everybody else doesn't get to see you. You're definitely going to want to hear from Nadeem. You're definitely going to want to hear from Zach and Lee and Leo and a bunch of really smart investors in the house. So please feel free that if you're chatting with us, change that blue box where you start chatting to panelists and attendees so that everybody else can give the feedback in there, not just us. And second is, if you really, really want the question asked on the show, as you'll see, the chat's going to fly. And the best place is this like Q&A segment. If you pop that open and you put your questions for me to ask GC over here, that holds a certain place in front of my screen. It makes it easier while I'm sitting here goofing off, rolling my tongue. It's there. I don't have to go cross-eyed looking for everybody and what they're saying. So welcome Robert Brown from Washington State, man. We got West Coast in the house today, right? With Leo, Zach, and Robert. And last but not least, if you want this fancy little spreadsheet you're going to see me fiddling around with today, go to jwbroi.com and you'll be able to download that investor toolkit that helps you calculate any ROI, anything anybody is trying to sell you, not just us. Anybody trying to sell you a property, you can put it through the JWB filter, which is a really comprehensive filter that allows you to make wise decisions. And it's not about getting lucky, right? It's about making smart decisions. Greg, do you know why I just said that?
I do know why you said that, yes.
Because we're about to start. We are about to be magically whisked away to our property of the week. That is 7171 Lucky Drive in West, Jacksonville, Florida, 32208. Boom, it's on the screen. Now you can see it. Look at this gorgeous thing. What do you think, Greg? Feeling lucky today?
I'm feeling lucky. It's almost like, there's so many sevens in the address too. This is like, you'd feel like this is like a casino is like what you're buying here. 777 Lucky Drive, right?
True story. Right before we went live on this, I go, Greg, can I buy this property right now? Let me make a phone call. I was like, take it easy. I am about to get in on my next property. So if somebody doesn't scoop this one up today, I'm happy to take it. But for those of us joining in your ear in the podcast at some point in the future, and you can't see this picture, 7171 Lucky Drive West. It looks like a 1-bedroom house for a price point of $129,000, 3-bedroom, 1-bath, driveway, estimated rent range between $900 to $950, leased for 2 or 3 years for $925. And the money, what we really come for here is this cash flow, this returning asset, this cash flow producing asset, where estimated conventional financing total monthly cash flow is $135 a month, and the estimated conventional financing total ROI is 8.45%. Patrick, we're going to get to that. Spoiler alert, we're going to talk about the recent Fannie and Freddie stuff. You know what, Greg, you want to talk about that right now before we get into the property?
Yeah, you know what? Why don't we go through the property first so everybody kind of knows it? I think it's a great jumping off point for questions that you have about the property first. So let's do that, and then let's jump right to this new thing that's happening with Fannie and Freddie loans.
Let's do it.
Impactful.
We're going to prioritize that. And Patrick, I love the early question. Please bring the questions in. I'm going to hammer Greg with questions the moment that they start coming in, like you just saw. But for right now, Greg, since we got some newbies on the show, talk to me about this $135 estimated conventional total monthly cash flow. What does that include? What does that not include?
Absolutely. So the first thing to look for when you're planning on buying an investment property, a rental property, is I want you to look at two things. I want you to see what amount of positive monthly cash flow is going to be returned to you every single month on a normal month. And then I also want you to look at the return on the investment, taking into account all of the positives and all of the negatives. So the first one is the total monthly cash flow. So it's important to think about this as an asset that has expenses that happen every single month, but it's paying for itself and then some. That's the beauty of this asset class. It's something where you can buy a rental house, take out debt, which increases your expenses on that property, but the rental income still covers those expenses and then some. And that's what that $135 a month is. $135 by itself doesn't typically change somebody's life, but when you have an asset that you can take smart debt out on and it pays for itself, it then becomes scalable. And for many of those on the call, whether you're investing in rental properties now or you plan to in the future, in order to accomplish a certain goal that you have, you're probably going to need to buy 3 or 5 or 10 properties, depending on whatever your goal may be. And so this idea that it pays for itself every single month then allows it to become scalable, allows this to be a model that you can really accomplish that goal. So that $135 specifically, what it is it takes into account your rental income minus the expenses that happen every single month, which would be your principal, your interest payments, your property taxes, your insurance costs, and your monthly property management fees. Those happen every single month. And we take the rental income, we subtract all of those expenses, and what's left over is that $135 estimated on this property.
There you go. So your average month, you're just sitting around getting a phone call from your portfolio manager. You spent 30 minutes on the phone. They tell you what to do. And you, at the end of the day, come up with $135 extra dollars for whatever you want to do with, right?
There you go.
You know, we got somebody who I think is another newbie in the house, Clay Martin. Welcome, Clay. Good to have you. And he says, I'm going to just go into this because it relates. So I assume your company collects the rent and manages the property if there are issues, correct?
That is 100% correct, Clay. Thank you for that question. So yes, this includes JWB's property management services as a part of this investment. We basically are coming to the assumption that you want this to be a passive income investment for you. And so you are going to want to have world-class property management along with the asset that you're purchasing. So yes, this would include the management fees that JWB would charge for you, which are really right in line with what standard property management fees would be across the industry.
Yeah, and I think he was just basically asking if you have property management. I think what Clay doesn't realize that he stumbled into not just turnkey, but complete vertical integration, right? So Clay, one of the things that I learned when I first started working with JWB, and that convinced me to become an investor with JWB, is this idea that they're not just a, property sourcing and property management company, or like not a middleman between property management or whatever. They do everything from owning the land to building the house to remodeling the house to having the property manager, having a exquisite funnel of tenant acquisition that has a big waiting list for the people that want to get into their houses. And then on top of that, they give you this portfolio manager that I'm talking about. I just recently became a client, and it's really just like a bright, bubbly young person talking to you about your money, your money, making money for you and showing you on a internet portal where every single dollar is going to go and where everything goes. Like it's really it's a really incredible experience. So Gregg, I feel like you didn't do that answer justice. So I had to
Thank you, brother.
But we have another question here that tees us right up, right? Justin Levin, again, welcome, Justin. Another new name that I recognize. He puts, do you include vacancies and repairs within the monthly cash flow? And I think this lends itself to you answering what this estimated conventional financing total ROI is, Gregg.
Yes, exactly. That is a perfect segue, because that the first metric we just talked about, the total monthly cash flow, is slightly myopic, right? It's talking about, does the asset pay for itself every single month on a normal month? Well, in reality, you want to cross that threshold, right? It's great for it to pay for itself, but you also need to look at some of the expenses that happen not every single month. And then also some of the upside, some of the additional return that happens in other places than just hit your bank account. So on the upside side of things, right, you also have additional profit centers beyond just net rental income. You've got your principal pay down, which is your resident paying your loan down for you. That doesn't actually hit your bank account. When the resident pays the rent to you and your loan balance goes down when you make the payment, that's just showing your loan balance going down. So that's an additional profit center beyond net rental income. So that's good. You also have tax savings. This is money that you don't have to pay on the income you earn from your rental properties. Whereas, if you're in a different asset class, if you're in the stock market and you take a short-term gain on a stock sale, you have to pay your federal income tax bracket. Well, you don't have to do that with rental properties in most cases, because you get these incredible tax advantages. So there's a tax savings component to rental property investing. So you want to include those two profit centers. And to his question, it was about including maintenance costs. Well, when you're looking at the return on investment, the total ROI, you want to take into account expected maintenance costs, vacancy costs. You also want to take into account your tenant placement fees, which is the cost that it's going to cost you when a new resident is put into your home, which you're going to have a new resident put into your home. That's kind of the basis here. You have to have a paying resident in there. So you want to include all of those costs, and we do include all of those costs. And that's what's reflected here in that total return on investment number, which for this property is estimated 8.45%. Right now, the market's bearing over 8%, 8 to 10% is really what you'll see as far as cash flowing passive income rental properties in Jacksonville. So if we can get over 8%, we're really happy to bring this one to you. And that's what we've got here.
There you go, Gregg. And a little teaser for later, because I want to get into this Fannie Mae stuff. But you mentioned a bunch of profit centers and cost centers, and appreciation rate being one of these major profit centers that differentiates the Jacksonville market. So just letting you all know that right now that's at 0% appreciation rate, and we're going to explain why. But I think it's time to get into the question du jour, which is French for question of the day. And that comes to us from Patrick Kelly and also Zach Correa, where they essentially have very similar questions. Of course, Zach leads off with his trademark "Aloha, Gregg," but he asks,
Zach.
Both Patrick and Zach are asking, what's happening with Fannie Mae getting stricter with investing property loans? How do you think that that's going to impact the rental income property market?
It's a great question. I've been hearing this from clients this week. This is big news. And I'm so glad we have a forum and a platform here to talk about it, because I do think it's going to impact turnkey rental property investors. It's going to impact second home purchasers and purchasers of all types of investment properties. What's happening here is certainly not unexpected. We have talked for the better part of a year now about how the deal is the debt. The deal is the debt. That means that the financing that is available today and has been available since COVID hit is the very best, most advantageous financing terms you will ever see. It really is that way. I mean, literally, interest rates have never been lower when it comes to the financing that's been available as a result of where the economy is post-COVID. And that's why we came so strong, and I've been sharing this message about, I've always been a believer in smart debt, but right now it just is such a wealth generator to understand how to effectively use smart debt. Interest rates, right now we tell people to expect 4% interest rates on investment properties. And that's just so crazy low. When I started to buy rental properties in 2006, I thought I was getting a deal on the debt when my interest rate was 7.5%, right? The difference between a 7.5% interest rate and a 4% interest rate is monumental when you're talking about the ability to buy positive cash flow rental property. So we have talked about this as a moment in time where interest rates are the most advantageous, the terms are the most advantageous. This is because we went through coronavirus or going through coronavirus. What we have expected and have talked about a lot on the show is that you are going to see interest rates or the terms in some way, shape, or form become less advantageous as we go into the future, because the rates are artificially low now. So the news that came out this week is that the Federal Housing Finance Agency came out and said that Fannie Mae, which is a government-sponsored entity, which basically purchases loans that are originated by banks, they came out and they said that Fannie Mae is only going to purchase up to 7% of their portfolio as second home and investment property purchases. That's the ruling. Now, the effects of this are pretty far and wide, because to put a little context into it, I went and looked up and I was trying to figure out, what does 7% mean? Because I don't know, what does that mean, that Fannie Mae purchased 30% in the past or 10% in the past or whatnot? Historically, what I researched is that Fannie Mae has purchased about 15% of their portfolio has been second home and investment property purchases. So they are taking a measure to basically cut that in half. Why are they doing this? Well, I don't exactly know why, but they look at investment property loans as riskier than owner occupant. So they're trying to decrease their risk, probably trying to protect the ability for owner occupants to be able to get financing somewhere along the lines there. But what they're doing is they're limiting the amount of loans that Fannie Mae is going to buy from the banks. Ultimately, what's going to happen is this is going to result in higher interest rates for all of us who are buying investment properties or second home purchases. That's where it's going, because now the banks that you're getting the loan, who's originating the loan, may not be able to sell that loan to Fannie, which means that bank is now taking on more risk. There will, my thoughts are that the interest rates will go up, the terms will become less advantageous. You will see higher closing costs, or potentially higher interest rates on investment property loans, because this is the result when Fannie Mae makes any type of movement like this. I think that there still will be loans to be had, because right now there are loans that Fannie doesn't buy from banks that they originate all day. Right now, it's just going to be higher interest rates. It's going to be less advantageous terms, which is what we've known for a long time was going to happen. I just didn't see it happening this quick. This is a pretty bold move to go from historically 15% of their portfolio to 7%. That's a pretty bold move, and it's really rubbing a lot of people in the real estate industry the wrong way. But it is what it is, and I think we're all gonna pay higher interest rates and have less advantageous terms.
Okay, so full disclosure, this is exactly why right before this call, I was like, Greg, let me pick up this property. But I have a question. The way that you explained that, I understand that what's happening is there is going to be less supply of cheap financing kind of for this industry, but I don't understand the terminology of Fannie Mae buying the loan, right? Is that because banks finance something to you and then flip it to Fannie? Or
Yes.
is it because when you default, Fannie is the one that takes care of it? Like, what do you mean by buying the loan? Like, I have a friend that doesn't know real estate as well as you do, Greg.
I'm so glad you asked this question, because you throw around terms like buying loans, and what does that really mean? It's the first thing that you kind of guess there, right? So what happens when, Pablo, you just bought your first rental property, right? You got financing on that rental property. I don't remember which lender in our network you worked with, but that lender originated the loan. And that lender then takes that loan, and that lender knows that it can then sell that loan to Fannie Mae. So that's what allows this capital to continue to be there, right? If banks had to hold all of their own paper, there would be less lending supply out there and people would not be able to buy nearly as many homes because there would be less lending available. So the entire banking and lending model is built on the backbone of Fannie Mae being able to basically buy the asset, buy the loan from the bank. So banks knowing that they have this end buyer on the loan at the end of the day helps them make more capital available. And it also helps them keep interest rates low because it decreases their risk. So now what happens is Fannie says, I'm only buying up to 7% of their portfolio as investment property loans. Now, I don't know anybody who knows what percentage Fannie is really at right now, right? So I haven't been able to find that anywhere. It's not readily available. So if I'm a bank now and I'm making loans today, I'm saying, wow, I know this is coming. I don't really know if the loan that I'm making today will fit with the Fannie Mae criteria. Because what if it fits all that criteria? The borrower is strong, there's no issues along that line, but it's 7.01% of Fannie's portfolio. They're going to deny it. And so that creates more risk for the bank. In order to offset that risk, the bank now is going to charge higher fees for closing costs, higher interest rates, some combination of the two in order to offset that additional risk.
Okay. So now I'm understanding it as you're saying risk. I'm thinking in my head opportunity cost, right? Because if a bank can like go close a transaction with a certain amount of money and then liquidate it on the back end and then use that same money for something else, they know that they can just pass through, make that rip, and then go use that money for something else. So now banks are thinking, oh, I need to be smarter with this money because it's going to be tied up longer. I can't just kind of flip it and leverage it and whatever that I was doing before.
Yeah. And it's not like they're not going to have the ability to sell the loan, right? There are other players that they can sell the loans to today that are they're non-conforming loans, right? Non-conventional loans, right? This has always been an opportunity. Like there are some clients right now that want to buy properties number 12 and 13, right? And they might have 10 properties that are already financed. Well, one of Fannie's rules right now is they will not buy the loan unless there's 10 or less financed properties on that borrower's credit. So we're still able to get financing for those individuals. That bank may either hold the paper themselves or they might sell it to a different lending source other than Fannie Mae. But either one of those two options results in higher fees, interest rates, or closing costs for buying non-conventional loans. So, and that's what will happen here. There will be more players that will be scooping up all these other loans that Fannie refuses to buy, but they're just not going to be able to get anywhere close to the low interest rates and low terms that you can get when a bank can flip that loan to Fannie and be on to the next one.
Makes sense. Makes perfect sense, right? Because they can just turn that money and then go get something else, right? Like it's a very low opportunity cost.
Exactly.
Cool, man. All right. Well, we could definitely, number one, amazing questions coming in on both sides of the equation here. And I'm going to focus a little bit on the property, right? Because I think we've got some new folks with us. They want to get technical on the property and ask you some technical stuff. And then we're going to have plenty of time to pontificate and talk about what this effect will be for the market. And the other thing is we have a lot of people today in the house. So I would ask that if you are submitting questions into the chat's moving really, really, really fast. And I already have like 6 questions in the Q&A that are sitting there looking at me in the face. So if you could use the Q&A for me, it would really, really help me out. Or else I'm going to go cross-eyed.
And one thing to add there, we put additional support here to be able to help as we have more and more friends joining and more questions asked. If you can put it in the Q&A, I guarantee you that a member of my team will get you the answer, even if we can't answer it on the chat today. If it's in the Q&A, it's there. It will get answered either today or in the future. It's in the chat. We have no way of kind of cross-referencing that. So it's a good idea to put it in the Q&A.
There you go. That's another help me help you. So I'm going to answer one simple question here, Greg, that Clay Martin asked in the chat. I'm just going to move it forward before I forget it. If I want to sell the property, would I be restricted with your services?
Great question. The simple answer is no. When you buy the property from JWB, you own the asset. You could do whatever you decide to do with it. But before we would get to that point, Clay, we're going to make sure that you're set up for success. So we have an entire onboarding process where we go relatively slow with new clients coming on board. Usually it's multiple phone calls. And part of that is to make sure that you're going to succeed in this asset class. And this asset class is built upon buying and holding for the long haul. And so if you share with us that your intentions are to probably sell in the next year, 2 years, 3 years, really 5 years is our minimum threshold, we're probably going to, suggest that this might not be the right model for you, or at least the right fit for you here, just because when you buy and sell rental properties, it's an illiquid asset, and there's a lot of costs that come along with selling real estate. And we wouldn't want to put you in a situation where you would take a loss on the property or have to depend on too much property appreciation to offset those costs. So first thing is that keep that in mind. Make sure you're in for the long term. And then when it comes to actually selling, we're going to facilitate the best opportunity for you to maximize your return. Many times that's selling on the open market to an owner occupant. And we would make sure that we refer you and put you in touch with a real estate team that we trust to be able to handle that for you. So simple on the back end.
Yeah. So you own it. You're free to do whatever you want with it. Just you would like to work with people that are in it for the long run. So if that's already your plan going in, probably not you're going to give them the best advice you have to give, which is, you're more thinking more of a flip scenario. But if something goes wrong in the 5 years, of course, you can always sell it, whatever.
Absolutely.
Cool. So Mike Foster, welcome back, Mike, says that during a recent broadcast, you discussed that properties on a city sewer would have an estimated maintenance cost of 6%, while it would be 9% on a septic tank. Last year, you mentioned that projected maintenance costs for new construction were about 4% and for renovated properties, 6%. Just trying to reconcile those maintenance cost estimates of new property versus renovated, sewer versus septic, 4%, 6%, all that stuff. Can you kind of run through that?
Mike's spot on. So one of the cool things that we do is we track all of our maintenance costs. And we've been tracking this since 2011. So there's over 2,000 properties that we've sold. And we actually track every dollar in and every dollar out. Every single month, I look at it. And so when you do this, then you can start to analyze what really are the right expectations you should give to clients who are purchasing a property today. Based on 2,000 properties that have been performing since 2011, you can really narrow it down to what most likely your maintenance experience is going to be. And the other cool thing is you can start to dissect that data, right? We have this data flywheel that we've created where you can start to say, all right, well, this type of an asset has this type of maintenance expense, and this type of an asset has this type of a maintenance expense. And so we've identified either new construction, or if it's a renovation, either septic or sewer as some of those key drivers. And so the data suggests that for a new construction property, no matter if it's septic or sewer, you're going to see 4% maintenance costs over the long haul. And that's 4% each year over the long haul. So we've built that into the property valuation for new construction. On the renovation side, you're going to see slightly higher maintenance costs. And so if the property's on sewer, then it'll be 6% of the gross rents is what you should estimate for your maintenance costs. And that's built into the evaluation. If it's on a septic tank, you're going to see even higher costs, which should probably make sense for those who own rental properties already. If you have a property that's on a septic tank, it's not a bad property. It's just going to have slightly higher maintenance costs than if it was on city sewer over the long haul. So you need to get a better deal somewhere else in that equation, right? You need to pay a little bit less for the property, or you need to get a little bit more rental income, or your property taxes need to be a little bit lower to offset the additional maintenance costs. And so the data suggests that 9% of gross rents is what you should set aside for a renovated property on a septic tank. And so the really cool thing is we put these into every evaluation that's prepared in advance. Then we hold ourselves accountable over the long haul to be able to see how we do on your individual property and your portfolio, make sure that we're performing there. And when we do that, it basically creates an opportunity for us to under promise, over deliver, set the right expectations, and to give really more accurate expectations. The industry's kind of the dirty little secret in the industry is nobody has this data. Nobody tracks it on an individual level like we have. And so everybody just kind of makes it up. When it comes to expected maintenance costs, you'll see 5% or 7% pretty standard across the board, regardless if it's new construction or renovations or septic or whatnot. It's just not right. Your maintenance costs are highly dependent on your construction, your property management, how long your resident stays, and if there's a septic tank or not, if it's a renovated home. I mean, that's what we've kind of inherently, most people know this. So it just doesn't make sense that you should use a 5% or a 7% standard across the board. But that's what people in the industry do.
Gregg, when you start talking Silicon Valley tech business language like data flywheel as a real estate investing company, it makes the sides of my mouth turn up, man. It makes me really happy. I'm super into that. All right, so we gotta. I mean that. So anybody that doesn't, I'm a business nerd, right? That data flywheel is right in the center of the Jim Collins good to great kind of philosophy of building a business. It's right at the center of this category design thing that I'm obsessed with of building great enduring businesses. You just don't hear it in this industry, which I think is wonderful, man. All right. Joseph Albano has a couple of questions, a couple of good questions. Are the vacancy and maintenance calculations fixed at the percentage shown or variable as expensed?
Great question. And they are fixed on this spreadsheet, and in our assumptions, they're fixed because that is based on data. Again, that's been tracked since 2011 over 2,000 properties. So our thoughts and our theory here is that if we have that much data and it's the same type of assets that you're purchasing, that over time, over a 10 or a 20-year hold period, your data is going to match what the massive amount of data is that we have. So that's fixed at that 3 and 6%. But I did want to add that we make this available. And what Pablo mentioned at the beginning of the call is that we have this calculator built for you to use. And so if you want to use a different percentage, we make this available for you. You can go to jwbroi.com, and then you can change this percentage to whatever you decide is the right fit for you, depending on what market you're investing in. Even if you're not investing with JWB, use this tool as the basis for how you're making your decisions. And so if you want to put 4% in there for vacancy or 5% or 2%, it's all you.
You kind of jumped ahead of the next question by Joseph Albano when he asked, how sensitive is the ROI on the loan rate? Does your spreadsheet allow you to play with the loan rate to see return? Should we fiddle around with this thing, man?
Absolutely. And I think this is going to give some concrete examples to the topic of what the Fannie Mae change will do in the future to cash flows, to return on investment. Like, let's look in the future here as we see this Fannie Mae change is coming into effect April 1st. So you're going to start to see impacts of this, and then start to think about where interest rates are going to be in a year, 2 years, whatever you feel like we're going to recover from coronavirus economy, right? Start to see what impact this has, and then think to yourself, when is the best time for me to be buying rental properties with financing? And I think you're going to come to the same conclusion.
Real quick, I'm going to just kind of show him that you can mess with this first, right? So maintenance rates goes up to 9%, right? You're dealing with somebody that doesn't have a data flywheel, and they're telling you it's 6% because they read it in a magazine, but it's really 9%. Boom, it affects your return, right? So you can mess with that there. And then now let's go into this real life scenario of what's coming down the pipe with old Freddie and Fannie, our friends.
Yeah, absolutely.
So where do I need to go, Gregg? This isn't my area of expertise here.
Yeah, no, you're good. You're column H, row 7 there. There you go, 4%. So I have no idea what interest rates are going to be based on this. I don't think anybody does, right? It's too early to tell. I feel really confident that even when this happens, we still are going to be able to source loans at 4% for our investors. So we have not made a shift to 4%, to that 4% number based on this information. Part of the reason that we don't have to shift like that is because we underpromise and overdeliver when it comes to interest rates, because cash flows and returns on investment are so sensitive to it, right? Another way of saying this is, Pablo, you just bought your first investment property. Do you remember what the interest rate was on your loan?
I believe it was like 3.6.
3.6, right?
Yeah.
So we have built this knowing that there was a buffer because I expected interest rates to go up in the future. And I did not want to have to come here on short notice and say, oh, okay, cash flows drop to this, returns drop to this because of something that we saw was going to happen at some point. So this under promise and over deliver mentality that we have plays well here. 4% is something we still feel confident that if you put a property under contract today and go get a loan today, you'll still be able to source a loan there, assuming you're putting 25% down like we have on the sheet here. So, but I don't know when, but I know that rates are going to go up over 4%. I know at some point here, we're going to be doing the property of the week, and you're going to see a 4.25% interest rate or 4.5% or 5%. So let's just play this out, right? If interest rates jump up to 4.5%, just change that number there from 4 to 4.5%. See what that does to the return on investment. Drops your returns by a full 1.5 points. Drops your cash flow about $30 a month, right? That's a 0.5 point. Now think about this, right? It was insane to me when I realized that we could source investment loans for turnkey rental properties in the 4s. Like we have been operating in the 5.5% interest rate place for years now before coronavirus hit, right? And a full 1.5 drops of returns drops just by the interest rate going to 4.5%. Now bring it up to 5%.
All right, bringing it up to 5%, getting crazy.
Yeah.
Oof.
All right. Your cash flows are going way down here. Now it's $77 a month, estimated cash flow in a normal month.
What's
right?
the cash flow? Yep, now 77.
Yeah, your return on investment dropped from 8.5% to 5.75% return on investment. This is where turnkey rental properties are going. Now, do you want me to scare you a little bit more?
Sure, Greg, I'm in.
All right, cool. Go back to the summary page. All right, keep it at 5% there and go back to the summary page. Now, okay. Pablo, what's going on with prices right now?
Prices are going up.
Prices are going up.
Short term, you said you're predicting 8 to 10% this year.
Exactly. Prices are going up across the board. You're going to find that turnkey operators cannot stay in business because their acquisition costs go way up and then the sales prices go way up. But the problem with that model for other turnkey operators is cash flows go down, return on investment go down, and they don't source their own inventory to be able to keep it cash flow positive, which is what JWB does. But let's play this out. Go to, it's $130,000, let's just say 10% is adding $13,000 onto it. So let's make the purchase price $142,000. This is what JWB thinks purchase prices will do over the next year. We think that they're going to go up 8 to 10%. Now look at the compounding effects of the purchase price going up to $142,000 and interest rates going where I think most of us believe they're eventually going to go back to. And now look at your cash flow. It's $25 a month, right? Your return on investment is down to 4.29%, right? This should be an aha moment for everybody. This is why we do the show, because this is such a moment in time where your cash flows today, your returns on investment today are stronger than they're going to be a year from now. I can guarantee you that. There's no doubt, right? Yep. And that's where we're going.
All right, man. I'm gonna try to return it all back to normal so that when we fiddle up with everything else. But true story. This is why exactly when you told me that right before the show started, I was like, can I buy this property right now? Right? That's what do we have this at? 4%?
Yep.
Okay, 4%. And by the way, you can also mess around with, I know Luke DeJong asked me if I paid 20 or 25%. I put 20%, right? So, the sheet is fully functional that you can use it with anything that you'd want to do, and it'll change your ROI and everything that you're going to do with it. But yeah, that scenario on a very transparent level is the reason why I just cashed out my Peloton stock. And now I am looking to be like, all right, I just need to get in on this right now because there's going to be another stock that's going to do its thing based on my whole category design lens. But this asset class, based on Rich Ritchie being on the show 6 months ago and predicting that this was a moment in time as like a VP of mortgage at Truist Bank, and then, and then seeing what's happening. And now, just seeing the activity that's happening and months of ROI, months of inventory in the Jacksonville market being so low is the full reason why I have reallocated the little bit of nest egg that I have as I'm building my own business to say, okay, it's time to get into this now if I ever want to be a rental property investor, and the rest I'll figure out. Right? I mean, it's weird to say, but that's true. Okay. So Nadeem Shaw asks, how soon does Fannie Mae go into effect? You already answered that. That's April 1st, right?
That's right.
Sheila Bishop asks, do your lenders sell to Fannie Mae?
Yes.
Easy peasy. Clay Martin asks, how does the calculation change if I pay cash for it? how do I get a copy of the financial on this? And if I wanted to buy it?
We'll start with the last question first. So the way to start the process of buying this one is to jump on the phone with my team. So you can schedule your own appointment by going to chatwithjwb.com, and my team, like the calendar is right there, and you can just pick a time and we can start that process. The really good thing is that as long as this team, this model, this market makes sense, if you're really interested in this property, we have a number of other properties that are very, very similar. So even if this one isn't available by the time you get on the phone with my team, as I mentioned, we go through this client onboarding process pretty slowly. It's very likely that this home specifically won't be available if you're just starting the conversations with us right now. There will be other homes that are very similar, same neighborhood, same price point, same returns on investment, all that good stuff. So get started on the process, fall in love with the team, the model, the market, and the property. Even if this one isn't available for you, there will be one that is very similar there. And then how can you get...
Can I say something real quick there, Greg?
Yes,
we really dove deep into that on Tuesday's call. So something that if you're new here, Clay, that you may not know is we have this Facebook group that has 2,500 other investors in there. It's the JWB Rental Income. I forget the name of it. I'm gonna put the group in the chat. It's just jwbfacebookgroup.com, and we're gonna release that episode of Tuesday's show on YouTube next week, but it's live in the Facebook group right now. And it really talks, it is somebody just like you that was, thinking of the psychology of one versus another and team or not team and property first. We went very deep into the idea that he chose to invest with somebody that did not exclusively try to sell him a property as much as selling them team before deciding on a property, which is the way that JWB does it. So it's a good kind of like look at it from your own eyes and not from Gregg's eyes. If you want to see it there, that's in the group. And if not, it's going to be in our YouTube channel in a week. So sorry, Gregg, continue. So we're talking about how does it look if he buys it in cash?
If he buys it in cash, that is a pretty simple equation. If you go to that analysis cash tab down there at the bottom there, you'll start to see this. And we won't get lost in the numbers here, but there's a whole lot of numbers here that basically are basically suited for if it's an all cash purchase versus if it's a conventionally financed purchase. So in the way to get this spreadsheet, actually, we have all of our properties of the week have the actual spreadsheet available for you now. That's a new thing. So there's a new website to go to check that out. If you want this specific actual property evaluation so you could download it yourself, it'll be available for you starting this Friday. And you go to investwithjwb.com. If you go there and you kind of just keep that in mind, we're always going to take the properties of the week and have those available for you with the actual client or with the actual portfolio. Sorry, wrong word. Property evaluation for you to download. So keep that in mind. So that's there for you. It's got all the numbers. You can see that. At the end of the day, when you buy in cash, your cash flows are higher for you on a monthly basis because you don't have a mortgage payment to make, but your return on investment is actually going to be lower because you're using all of your own cash instead of using the bank's money or other people's money. So higher cash flow for cash purchases, lower return on investment, especially when it comes to appreciation over the long haul.
Okay.
Did I forget any of his questions?
Man, there's so much happening in the chat that I'm trying to manage so that it doesn't erase that I haven't been paying the attention I should be paying to you, Gregg.
Oh, good.
Okay. So I think you answered it, Clay. If he hasn't answered it, let me know. We're getting a bunch of really good stuff, right? Like, first of all, Luke DeJong, you're the MVP right now. Gregg and I kind of like really want to hold ourselves to the standard of talking about the things that we talk about in the Zoom invite. And we haven't talked about this significant rent upside piece, Gregg. So I don't want to drop the ball there. Can we get into that? Thanks, Luke, for reminding us of that.
Absolutely. And a lot of these questions are so good about wondering about ways where, the maintenance cost might be higher than expected. How do you know that your maintenance costs are going to be that percentage, right? There is so much that can change for your return on investment just by small tweaks when it comes to maintenance percentage or rental income percentage. And I want you guys to think about that because if you're a seller of a turnkey property, you know that as well. And if you're a seller, what most people in this industry do is they try to put the absolute best case possible scenario forward on a property evaluation for you so that you'll see a higher return number so that you'll want to buy it. And we don't operate that way. One of our core values is to underpromise and overdeliver. And we feel like in the long run, we all benefit from doing it this way, because if we can bring you on board as a client and set your expectation as far as what your return on investment should be right here, and if we can just simply hit that or hopefully do a little bit better than that, you're going to come back and you're going to buy more properties with us and tell all your friends and family about us. So with all that being said, it really kind of dovetails well into how we priced this asset and how we presented the return on investment here. Because I don't usually go into a lot of upside in our conversations, because I try to underpromise and overdeliver in everything I do. But this is one that I feel comfortable telling you that there is significant rental upside, and you'll understand in just a second why. Pablo, if you kind of zoom in there, check out row 25 there. That lease says 2 or 3 years and a rate of $925. Typically, when you see that, that is exactly what the house is currently rented for. However, in this case, that is not accurate. If you actually purchase this home has just been leased to a new resident, and the rent is not $925 on it. Actually, that rent is $1,000 currently, with a rent escalator in future years. And this home is rented through 2023. But we care so much about underpromising and over-delivering that we know a lot about the market, a lot about the rents in that market. And we feel like this resident has paid a little bit of a premium to rent this home. And if you care about delivering long-term and you feel like the market rent for that property really is $925, then you set the deal evaluation based on a $925 rent, which is what we did. But this has upside, because actually the client who purchases this home will inherit a home that is rented for 2 years with a brand new resident who has signed up for $1,000 a month for the lease, which is totally different than how any other property, turnkey rental property provider will operate out there. I've never seen anybody do that, but this is what we believe is the best thing for you in the long run, and the best thing for us, so that we can underpromise, overdeliver, and keep you as a happy client for life.
So is there, first of all, I don't think anybody, and me included, is comfortable with the idea of thinking that somebody is showing you not your best face when they're trying to sell you something, right? Like, is there a reason why you didn't just put 1,000 in there, but then change the rest of the stuff to look a different way on this spreadsheet? Like, is there a way that, I don't know, man, was it like too hard of math? Like what? All
right, well, let me give you the other side to it. All right.
Yeah.
So we always sell the properties at market value. Mm-hmm. Okay. So even if I put $1,000 rent there, that's not going to change the purchase price, because the purchase price is the market value. So it's not like JWB is going to make more money off of this by us reflecting $1,000 of rent there, right? If you put $1,000 of rent there, it would bump up the return on investment, which, if you're thinking about it from the perspective of how do I underpromise and overdeliver, only makes our job harder down the line, right?
Yeah.
Now, we could create this asset, it's over an 8% return, and we didn't have to, put the absolute best possible rent that we could collect on it there. So, I mean, if you're reverse engineering it would only make our job harder if you assume that there's a market and clientele ready to purchase at 8% returns, which we know is the case. So does that give you the flip side?
Yeah, that gives me the flip side. So when you say significant upside on rent, it's the idea that right now these numbers don't reflect the actual amount of rent that you're getting in the first 2 years already. And two, if you're getting it for $1,000 right now, maybe the next one is that you just aren't gonna like step out and say that.
So rents are rising in Jacksonville. And so, we have a lot of data real time here, and this is what we would estimate that the market rents are between $900 and $950 for this home, but rents are rising. So it is not unique that somebody would pay a $50 premium or what have you to rent a property today because they fell in love with the home and their family lives right next door, or whatever the situation may be. So it's not like there's anything, different about this, but we just look at this as our normal assets right now are performing at about an 8%, 8.5%, 9% clip. If we can get a little bit more rent right now for everybody, that's great, right? That then goes and buffers us for the rainy day, which will happen. And the client who owns this property probably is going to own 3 or 5 or 10. And at some point, they're going to have a rainy day, right? They're going to have an eviction. They're going to have a maintenance cost. That's a big cost, right? So we think about this in terms of the returns are where they need to be for all of our clients right now. If we are over renting, basically based on what we determine that market to be, we're still going to set the expectation of if we needed to rent it to another resident tomorrow, what do you think we could deliver that rent? And then in the short run, any additional rent that we can get because we have this wonderful resident who's signed up for a 2-year lease and will probably be here for a long time. That's just giving us a buffer and hopefully setting us up to over deliver in the long run.
Yeah. Listen, man, the depth that you think of the under promise over deliver is really impressive to me. Like, right, when we go on our morning runs and you're like, and I'm building out my business and you're giving me advice as the businessman that you are. And you're just like, no, man, like at every step of everything that you say, if you know that you can do better and you're telling them this much, then the initial experience is going to be this much better, which leads down the line, So, you're just showing that here, man, which I think is really, really interesting. Robert Brown over delivering here in the chat. He put a rentometer in the chat that says the average rent is 880, medium is 900, 25th percentile is 769, and 75th percentile is 990. So that sounds like this is rented well above the 75th percentile, but you're only estimating that you can definitely get like right above the median, which sounds about right.
There you go.
Under promise, over deliver. Greg, how are you doing on time, man? Can we go above 1:30 right now? Or do I need to kind of like pick and choose here and manage these questions? Cause we got a lot of great participation here.
I'm good, buddy. I'm good till about 1:45.
1:45. All right. You got it, man. And yeah, you're right, Lee. Pablo has a personal mentor in Greg on business. Great to hear it. It's true, man. It's really, really, I'm not going to get too cheesy about it, but our relationship has affected my life in a very positive manner. Joseph Albano, excuse me, Joseph. Joseph Albano asks, how does appreciation factor in down the road? We haven't gotten into this little goose egg right here that we love talking about, Greg. You want to tell us why it says 0% appreciation and what that means down the road?
Yeah. So as you guys can kind of see where turnkey rental property is going, you're going to find that cash flow positive is going to be harder and harder to come by just based on the economics of prices going up and interest rates going up, right? So the question should be is, why should I continue to invest in rental properties in a year from now or 2 years from now? And that would be the answer to that would be the same reason that people have been investing in rental properties before this amazing scenario where we got positive cash flow, which is there's actually 5 profit centers to be investing in rental properties. It pays you 5 ways. One is net rental income or positive cash flow, but then there's tax savings, there's principal pay down, there's home price appreciation, and there's inflation hedging. So there's actually 5 profit centers. So what's going to be happening is that people are going to be paying a lot more attention to the 5 profit centers rather than myopically focusing just on positive cash flow. That's where it's going. And when you think about of the 5 profit centers, what is the most impactful to you over the long haul? It's not positive cash flow. It's not tax savings, it's not principal pay down. It's actually home price appreciation, especially if you're using conventional financing. We'll take a look at this in a second here. So the most impactful profit center is home price appreciation. The problem with home price appreciation is you have to hold on to the asset for a long time in order to count on it. Because what happened prior to 2006, which is when I started to invest, prior to that, everybody thought real estate always went up every single year, that home values went up every single year. And then everybody was dealt a difficult lesson when in 2008 to 2010, home values dropped 35% on average, which nobody thought was possible. And since then, people have gone the other way and they've said, I'm not going to count on home price appreciation at all. I'm not going to count on it. I'm not going to evaluate. I'm not going to put it into my decision-making criteria. And that's also the incorrect way to do it. Because if you actually look at real estate, it is cyclical. You may have heard this before. And a real estate cycle, by definition, means that it repeats itself over time when it comes to home prices. And so what happens is if you give it a full market cycle, you're going to see that your home price appreciation in the next market cycle, which is known to be between 10 to 20 years, is most likely going to be very similar to what it's been historically. And so if you take 10, 15, 20-year segments and you look at what their average appreciation rate is per year in your area that you're investing, you're going to find that most of the time that's very close to what the historically accurate average is. So all this comes down to, why do we put 0% appreciation here? Well, Jacksonville is a growth market, but in order to count on home price appreciation, you need to be investing for a full market cycle, 10 to 20 years. If you do that, you should be counting on home price appreciation in whatever market you're investing in. The historically accurate home price appreciation rate in Jacksonville is 4.3% per year. And that data is from the Federal Housing Finance Agency. So if you're investing for the next 10 to 20 years on this property here in Jacksonville with JWB, you should be putting that appreciation rate in there. And when you do that, just like Pablo just showed there, your return on investment skyrockets because you're now capitalizing, you're now taking into account that appreciation profit center. And the only reason that we put 0% in there in the beginning is because I don't know if you're going to invest for the full market cycle. If you're only investing for 1 year, 3 years, 5 years, I don't think you should count on home price appreciation because it's too speculative. You need to be in that full market cycle, and that's why it makes so much sense to buy and hold. That's why I'm such a big proponent of it.
All right. And when I did it, it went from 8% to 24%, right? So that's 4.3% appreciation rate. It seemed like it jumped more than 4%, Gregg. You want to explain that for me?
Yes. And this is, again, kind of tying in why I'm such a proponent of smart leverage. Smart leverage means that you're taking debt on things where it's inexpensive debt. Inexpensive debt would mean like paying 4% for interest on it. So inexpensive debt on something that pays for itself, including that debt every single month, and then goes up in value over the long run. Right? Those three components are when I believe you should take out smart debt. And that's what you have with these assets in Jacksonville. Inexpensive debt, 4% as the interest rate. It pays for itself every single month. You're seeing a positive cash flow situation here. And then over the long haul, if you give it a full market cycle, it goes up in value. Just a fun fact here. People might not be aware of this, and many people are actually kind of floored when they hear this, but we just had the greatest recession or the greatest drop in home values from 2008 to 2010, 2011 that we'll probably ever see in our lifetime, right? Home values dropped 35%. But if you expand your horizon out to a full market cycle from 2001 to 2021, the average annual home price appreciation in Jacksonville is 4.3%, right on the dot. That's kind of crazy. And I can't see anybody's mouths going, ooh, ah, but I hope you are, because that is crazy. In the biggest drop, the most volatile housing cycle that we probably will ever see, if you take it out to a 20-year segment, it still has appreciated at the same historical home price appreciation rate, which is an average of 4.3%. So I got so excited about that. I forgot what the original question was. Where was I going on that?
No, we were just showing home price appreciation. I know you like, I love you who has zero like love for the dramatic. I love where you got really excited and you're like, drop it and oohs and ahs. That was, I really enjoyed it.
It's what you do in this, virtual world where you're not in front of people.
Awesome. Hari, the address of the property is 7171 Lucky Drive West. So it is a lucky property. Robert Brown is in the chat asking for horror stories. Like, he's saying all this sounds too good to be true. Have there never been any horror stories, Gregg? Is there ever is it true that it never goes wrong?
Oh, there's many horror stories. I've been investing in rental properties myself for about 15 years now. I own over 300 rental properties. I have more horror stories than you can imagine. I think the concept here is that you need to build in expectations for horror stories when you're buying rental properties, right? Now, obviously, you have a management team here. Our sole job is to limit maintenance and vacancy costs and tenant turnover. And your horror stories are revolving around maintenance costs, vacancy costs, tenant turnover, right? Our whole job is to limit that. So let's have a better quality of horror story. But the reality is, if you own a significant number of rental properties, you're going to have an eviction. You're going to have a high property turn cost where you have to put a lot of money back into the property when it turns over. The cool thing is that if you work with a provider who has this type of experience and data, this data flywheel for you there, Pablo,
Yes.
then you can take all of that into account, and you can know going in what your experience is most likely going to be. And then if you take your experience and you have a long-term horizon and you're investing for 10 or 20 years, I have even more confidence that your numbers are going to match the 2,000 other data points that we have that have been through that process already. So lots of horror. I mean, I can give you a specific one. Horror story that I never expected is a little thing called COVID and, eviction moratoriums, right? I mean, when we started to talk about this with our show here and with clients in the beginning of March of this year, I just got up here and just said, I'm an owner of rental properties myself. I don't know what's coming down the pike, but I would expect everybody should see a short-term temporary loss of rental income, because I didn't understand how people were going to have enough income to pay their rent. And I didn't see people going out of their house to go and to go and work. And it didn't make sense to me. That was my first moment. And that's what we shared here on the show. As it turned out, rental properties as an asset class in an environment like we are in with COVID, there hasn't been a single asset class that has performed better than single family rental properties in the Southeast, like Jacksonville, Florida. I mean, that's just the reality. A lot of the stimulus went to help people pay rent who are in a situation where they cannot work. So that stimulus really helped. There's additional opportunities for us to work with charitable organizations and also even organizations that the city has provided to help with rent assistance. And at the end of the day, while I was really scared in this incredible horror story, and I didn't really have an answer for in the beginning, we've collected over 98% of rents in all of 2020. 98% of rents in a COVID year where there's an eviction moratorium is what we collected.
What were you guys estimating when you huddled up, Greg? I like this one.
I mean, I didn't even know. I didn't know what to do as far as giving an estimate for what rent collection would be during a COVID environment where there was so much unknown. I said 70% was going to be a win for rent collection. I didn't know. That's why I came on the show and said, guys, I would expect a short-term temporary loss of rental income. And, our standard in a non-COVID year is 98.5% of rents collected. So for us to be at 98% is an incredible testament to my team. But I also think it's an incredible testament to this asset class, because other single family operators who are at our level are also sharing these success stories as well. So for those investors who bought into an asset class that preached consistency, that preached investing in something that's a critical need, you all made a great decision as well, because the alternatives of where to put your money at that time were even more scary, in my opinion.
There you go. I don't know if that sounded like a children's horror story, but whatever.
Oh, wow. It was a horror story when it broke in March, I'll tell you that.
Yeah, no, I remember. I was there. Yeah, no, listen, I've just been telling Robert, is like, you don't even have to ask Greg, right? Like, obviously, we're going to talk about positive things, and you admitted that there's horror stories, but like, go to the Facebook group, right? Like, talk to anybody, Get it straight from the horse's mouth at jwbfacebookgroup.com, 2,500 people. I feel like you can get a pretty good sense of your reputation in there. All right. So Keith and Sansan.
Let me just say one more thing here. The reason why we go slow with bringing clients on board is because we want to talk about those horror stories. So we're going to show you, of course, the positives of investing in rental properties. We're going to talk about the 5 profit centers and all that good stuff. But we're going to we have about about an hour that we're going to walk you through an actual client's portfolio. And we're going to say, hey, look at this year when they didn't perform well. What happened? There was a maintenance cost that was way high. Why did that happen? Oh, it was because there was a tenant turnover. Okay. How do we engineer this property management experience to avoid that? And that's why we sign long-term leases and focus on renewals of residents and whatnot. So don't worry, when you come through the normal process of client onboarding, we're going to go out of our way to talk about some of the horror stories, whether or not you ask us.
There you go. That's why I made the most atypical non-client call ever when they were trying to tell me about horror stories. I'm like, I bought in. I'm in. I've been like talking about this for a year. So, all right.
It was tough to go over with you. You were more problematic for me to sit down and be like, hey, listen, it can go wrong here, man. Well, this is what's going to happen if it goes wrong.
I remember, man. Like, I remember you asking me for feedback on the calls. Like, Greg, you don't want my feedback. Like, I was I was like the hardest person to deal with because I'm like, I'm in, just take my money. Then you're like, all right, let me stop you right now. Here's some expectations. This may happen. I'm like, fine. This is like
True.
6 a.m. after a 4-mile run. Good
True.
times, man. All
True.
right. Keith Antonson asks, property taxes are a big influencer on a person's cash flow on the property. Generally speaking, how do Florida's property tax structure and expenses compare to other markets?
Really well. Our property taxes are a lot lower than many other markets out there. A lot of markets go to property taxes to raise revenues. And of course, Jacksonville does that, but the percentage of property taxes actually in the state of Florida is actually lower than other states. I think of Texas and I think of Dallas specifically. One of the big drivers of why people don't invest in Dallas is because property taxes are so high that your cash flows really get hurt there, and it really takes people away from there. So yeah, property taxes are low in Jacksonville compared to other markets in the country. But again, I'll kind of give you both sides of the equation. As home values go up, what do you think happens to property taxes, Pablo? They go up. So the way property taxes are calculated is the city goes around and assesses your property, which should be loosely based on what the real estate market is doing. And so as your properties go up 10% in the year, and this isn't an exact science, but you can assume that your property taxes next year are going to be higher than what they are this year. And I didn't even show that in the equation as far as interest rates going up and purchase prices going up, but property taxes are also going to go up. So you should look at this as there is an assault on your cash flow that is coming in the form of higher prices, higher interest rates, higher property taxes. And the cool thing is that JWB has thought about this years and years and years in advance, and we can create our own inventory. And we have a very long runway of inventory for clients. So part of this, I'm trying to show you kind of the big picture of what is happening in the turnkey space, because I want you to recognize this unique opportunity that you have, but I also want you to have confidence that you can invest with JWB, and I don't see an end in sight of that.
Spoiler alert, before we get off here, we're talking about how next week is all these innovations that you guys have coming down the pipe that are going to preserve these numbers, but we're not going to get into that because you told me until 1:45, so I'm going to keep you to it. Cool. Stephen Donovan asks, and it kind of relates to this, has JWB always offered cash flow positive real estate, or has appreciation factored more into the numbers?
We have always offered cash flow positive real estate. I was kind of wondering the angle of the question there. Like, I guess he's asking if we always kind of put the appreciation rate in there to kind of juice the returns on the front end. Is that what you think he's asking?
When I read it, it just sounded like, have you always offered cash flow positive, or at some point, have you ever offered something that isn't cash flow positive, but appreciation is going to make up for it, which I think is the future of what's going to happen for everybody, right?
Yeah, exactly. So, we haven't. It's always been cash flow positive for us. We've been selling turnkey properties and investing for the last 15 years. So we haven't gone cash flow negative. It's going to be an interesting thing. The cool thing is that the next show that we're going to have here on Tuesday, we're talking about ways that we can influence this to maintain or slow the decrease of your cash flow going down based on what we know to be happening. And we can have a great influence on this. I think you guys are going to be super excited when you hear some of the initiatives that my team, headed up by Melissa Gillespie, is rolling out currently. So I don't want you to fear that this is all of a sudden, this is doom and gloom, and that this is an asset class that you're not going to be able to invest in a year. That may be the case with other providers in other markets, in my opinion. That will be the case. But for JWB, this is what we're built to do. We're built to see problems early. We're built to come up with solutions early. I think cash flows are going to go down and returns from cash flows are going to go down. But when you look at it holistically for all the profit centers, I think many people are going to look at this and they're going to say, consistency and all 5 profit centers, my return on investment compared to my other options out there is still really strong in rental properties. And we are going to do a great job of preserving your cash flow as much as we can.
That's the second teaser for next week's call, which I'm super, super pumped about. So let's go here. Joseph Albano asks, have you considered rent to own as an option for renters?
Have considered it, have done it personally. We don't do it anymore because it really doesn't kind of go in sync with what we believe the best return is for you as a client, right? We talked a lot about how when you factor in all 5 profit centers, you need to be investing for the long haul for that. You need to be investing for a full market cycle. So the rent to own conversation is where you basically rent a house to somebody and then give them the option to purchase it in the short run, whether that's 1 year, 3 years, 5 years. So that doesn't really play for our belief of what the best risk-adjusted return is for you. And then the other thing is, I've tried it on my own personal rentals way back in the day. There's a certain element where you're trying to help somebody be able to buy a home, but the chances of them actually acting on it and purchasing that home incredibly slim. And, you have to charge people for that. You have to charge people for the right to potentially buy your home in the future in form of what's called an option deposit. And so, I don't know, there's nothing wrong with it, but we've done it probably maybe 5 or 10 times on our own rental properties. And if you see 0 of those people actually come through and be able to purchase the home, it doesn't exactly feel great for us to do that and to have to charge these people up front if we just, it's very unlikely they're going to be able to perform. So that's a secondary reason, of course, for us. We just want it to be a win for all involved.
All right. I was extremely distracted because Stephen, first of all, great messaging. I know where you're going with it. Like it's the overall positive stuff, but Stephen Donovan asked me in the Q&A, he asked me, have I always had Outcast in the background during the show? Is this where the Where's Waldo scenario? Like we need to find it each week.
That's awesome.
That is the greatest question anybody has ever asked me on any of the 1,000 interviews that I have done on my podcast or here, because I'm the biggest Outcast fan ever. And I keep trying to find a place where it's more obvious. And I think I got it.
That's awesome.
So that was cool because I finally got a question about it. This is really awesome. Gregg, it's 1:44, man. This has been an incredible show. Like we said, on Tuesday's call, we're going to have Melissa Gillespie. JWB recently did something that, again, as a business nerd, I find fascinating. They had a full day employee generating idea kind of like workshop, and they took the best ideas possible and evaluated them. And now they're implementing a bunch of them, and they're obviously to the benefit of the client and of the resident and for everybody involved and the city, right? Like the vertical integration of benefits, right? Like, so I think it's really, really interesting. We're going to discuss at least 3 things that are going to maximize your ROIs going forward that JWB is innovating around. It's really, really fascinating conversation. I can't wait to talk about it. This has been amazing. I encourage anybody to go to jwbroi.com, get this tool. As I like to say, fiddle with it, right? I like the word fiddling. And we got a bunch of leftover Q&As here in the Q&A. Sorry we couldn't get to them, but we really, 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 really don't take for granted the idea that we've had like 50 people on this call for an hour and 15 minutes. That is spectacular in the middle of a Thursday. Thank you so much. It's really humbling to know that we're providing enough value that you take your time to hang out with us. And that was the JWB Rental Legal Property of the Week. Gregg, I'll let you finish after, buddy.
Thank you, brother. Thank you, everybody, for being here. These shows get more and more fun every single week, and it's a combination of the veterans of the show and the new folks who are joining and just asking incredible questions. I especially just loved your forward-thinking questions here. And I think that's a really big value that I can provide for you, is what's coming down the pipe to help you make the best decisions, because there are going to be significant changes to this rental property asset class that we know and love in the future. Some are going to be positive, some are going to be negative, right? But we're going to know in advance, and Pablo and I are going to do our best to bring it to you quickly and early. So we're excited about it. Thank you all for making the show incredible. And I'm super. Oh, and the last thing is, I love Pablo's suggestion about any additional questions you have going to the group. I'm in there every day. And if there's a question that I can't get to, post it there. There are 2,500 other savvy minds that are probably going to chime in and give a great answer as well. And I'll be able to answer your question there. So you don't only have to wait till Tuesday or Thursday for the show. So JWB Facebook group is our Facebook group. Hope to see you guys there, and catch you next week. Thank you, everybody.